Good evening, everyone. My name is Deep, and today I'll be discussing you about the basics of Forex. So, first of all, I'd like to tell you what is Forex is. Forex is a Forex where you can deal with a multiple currencies pair. Okay, like for an example, if you want to deal with the Euro USDs and any kind of a currency pairs, indices, stocks, those are called Forex. It's a huge market. The best thing about the Forex is that in this market, you can make money with a small amount, with a small volume size, without any risk. But yes, before going for a huge market, you should always be aware about what exactly you know about the Forex. Because in this market, Forex, we have multiple instruments, we have multiple commodities, items, or currencies. But you should be aware which market will be on your side and which market will be against you. Now, if I talk about gold, okay. Now, gold is one of the versatile market. Now, in gold, you can see there are multiple instruments. Like in gold, it's always be compare about it's going along with the dollar. Now, if the dollar is high in the market, gold will be low, and if dollar is low, gold will be going up. So it's against or vice versa. Now, this Forex gives you an open opportunities where you can do a multiple trades with the multiple instruments. But before you jump to any Forex, you should be always have a good learning position. Where I always suggest my clients that you should always learn the things, then you come to the Forex industry, or when then you put any trades on that, because the risk factors are always there. So if there is a probability of winning something, there is always a probability of losing also. Now with this, if I talk about how you can start, let's take an example. You're a new beginner in this market and you want to do a trade in the market. So what is the basic things you required for that? First of all, you should have an access for an MT4 and MT5 with your account number and password. Now let's assume this Forex industry gives you a leverage also. What's the use of the leverage? Leverage means with your small amount, you can go for a higher trades with a small volume size. So with this leverage, you can always go for a huge, if I talk about like if you want to buy something, a cost of $5,000 or $6,000, but you have only $500 in your account, you can always go for a small volume size with the help of leverage with for the same instrument. Now, whenever you open a trade, there is always have to make sure like whenever you're opening a trade, you should know which instruments you are looking forward to trade on and which instruments gives you more clarifications in this market. Now if you open any trade in this market, let's assume let's take an example of gold. Okay, most of the time, like let's take an example, 70%, 80% people doesn't know when to start the trade and when to stop the trade for any instruments, when to enter to the market, when to exit from the market, which is one of the most important thing. Now when you let's if you go ahead and start a trade, you should have a basic idea which instrument I'm dealing with, what is the amount is there in my account, and what will be the helpful, what how I can make anything positive with the Forex market. Now, what if I have $100 or $1,000 in my account? Everyone wants to make a money with a small amount. That they always look for a bigger picture. But we have to make sure, with this small amount, what is my probability that I can make the money, or what is my probability that I can lose the money? Now, this is where the Forex gives you a wide chance, where you have to enter to the market, when you have to exit from the market. This is where the MT4 and MT5 designed in such a way. Let's take an example. You open a trade with the gold, okay, with a small volume of 0.01. You go for a buy-by market. You clicked on buy-by market. Once you click on buy-by market, there is always a chance you can modify the trade. There is called stop loss and take profit. Now, stop loss means, for an example, I started a trade on a $10, but I put a stop loss on $9. It means if my trade from $10, it's going down. It's automatically stop your trade at $9. It will give you a $1 of loss and your trade will close in the negative. But you put a take profit of $12. Now from $10, if the market is it's going along with you, it's on the buy side. Okay. If the market is going to $12, the trade will be automatically stopped at the $12. It will give you the $2 of profit and your trade will be closed with the profit of $2. It doesn't matter how much further it will be going up, your profit has been already been booked. So we have to make sure, in trading industry, we have to make sure when to start and when to stop. We should know what is our risk calculations, risk management, what we call in the market. It means if you have a $10, you're buying something in the market, you put a take profit of $12, you're booking a $2 of profit and your trade is closed instantly. After that, if it goes to $13, $14, or $15, it's none of your concern because you have already booked the profit and you have already exited from the market. Same vice versa goes with the stop loss. If you put a stop loss of $9 from $10, you're buying something, and $9 you put a stop loss. Means if the market goes against you, okay, if the market goes against you, you put a $9 on the stop loss. Automatically, the market is going against you. The trade will stop with the $1 of loss, and your trade will be closed with a negative $1. It doesn't matter how much further it's going down for $7, $6, $5. The trade will be automatically get closed. So whenever you're entering to the market, you should have a calculation like this is my risk appetite. Now, if I talk about the risk appetite, I'm capable enough to make $100, but on the other side, I'm capable enough to take a risk of $50 also, right? In this market, there are multiple clients who wants to invest like $100,000, $200,000. They make money also. They lose money also. The basic principle, when they lose the money, they don't know the basic principles of the market. It means when you have to start and when you have to stop. There are multiple instruments in this market, multiple instruments, currencies pair, commodities items, indices. If I talk about indices, if I talk about cryptocurrency shares, there are multiple indices in this market. Now let's take an example. I have $100,000 in my account, and I want to start trading with any of very good shares like Tesla, Amazon. I want to buy those shares and I want to keep it for a long run. Of course, you can do that, but you have to check what is the quarterly reports are coming, what are the economic calendars have to say, what are the previous quarterly report for the Tesla company. Now let me give you a small example. Like for an example, I want to buy an Amazon shares. Now if I want to buy the Amazon shares, I should know what is the current price of the Amazon and what was the report, the quarterly report has been present by the Amazon. Because every month, every 3 months, every company, be it my company, be it any big companies, they produce a 3 months quarterly report. In this 3 months of quarterly report, they show to their clients, to the people, that what the exact profit they have made in this market and what exactly the losses they have done in this market. So in quarterly report, it gives you a clarification, what would be the best price to enter for the Tesla or for the Amazon, and you can keep it for the long run. Yes, there are some traders who doesn't want to do the intraday trading. They just want to buy something potential in the market and hold it for the long run. But yes, you have to keep an eye on the quarterly report, which the company has been producing from the past 3 months. There are people who wants to do the trading on a daily basis. Let's take an example. They are an intraday trader. They want to buy something potential. They want to sell it off by the day and they exit from the market, because this market gives you an access where you can make money from buying also and from selling also. Just assume I explained you about the buy market. Like when you have to when you're spending a $10, you put a take profit of $12, stop loss on the $9. When the market is with you book the profit, you exit from the market. Now, same goes on the sell by market. Sell by market, for an example, I have a $10 with me. I want to sell something on the market. I can see this is the market where the market will be falling today. Now, from $10, I enter to the market. 0.01 is my volume size. I sell the instrument. Okay. I put a take profit on $8. All right. Now it's just a vice versa of buy by market. I put a take profit of $8 and stop loss at $11. It means if the market is going further down from the $10, it will easily book the profit for me, and trade will get closed after hitting the $8. Okay, it means you're making a $2 of profit out of it. And if the market is going against you, if the market started rising from the $10, if once it is touch $11 or $12, the trade will be get closed automatically by giving you a small loss. Okay. So this is the best thing about the forex. Like, none of the companies, or I would say, like, none of the market gives you such a vast experience where you can make money by judging the market, by making the money from buying also, and by from selling also. It just, you have to analyze some. So these are the intraday traders who like to buy the instruments, sell the instruments, make a daily profit with the small volumes, with according to their capital, with the volumes, and they want to stick to the market. Now there are some people who doesn't have a time. Like, what exactly the potential things I have to buy in this market, and how this thing's gonna work for me. Now for this, we have a dedicated team as a relationship managers who can give you the market news. Let's take an example. Today, the crude oil inventory was there. Now, the crude oil inventory came negative. How it will impact, for an example, how it will impact to the market. If you see the crude oil, when the report came negative, the market started falling down. This is why economic calendar, I always suggest my clients to learn about or teach about or check a news, keep himself or herself updated with the economic calendar. Economic calendar is a tool where you can see all the news like non-PFM report, CPI report, or I would say, like, crude oil inventories or FOMC meetings. Those gives you a clear idea how the market will react, or how the market will be with you or against you, so that you have a clear idea, and always keep an eye on the market news. Now, economic calendar also gives you an experience, or you can check the news, as I said, like quarterly report, like where I can check the quarterly reports. Economic calendar, you can always check on the economic calendars, like what are the quarterly reports are there. There are some traders who wants to do the trade on gold, like, like they wants to do the trade on gold, but there is an FOMC meeting. Sometimes you can win the race, but sometimes you have to be a patience. You have to keep a patience inside you. Rather jumping to the market, you have to be patient. Let's take an example. Today, tomorrow, or day after tomorrow, the FOMC meeting is there. Today the gold is running on 2000, 2025, $2020. We doesn't know what will happen tomorrow, right? We don't want to jump to the conclusion. Let the FOMC meeting. Sometimes the patience is the key of success. Rather diving to the sea, getting into the market, making a good money. You think like, I'll get into the market, I'll make a good money, I'll quit the market by taking the profit. It doesn't work all the time. Sometimes the patience, you have to keep it. Wait for the market news. Let's the market gives you the news, whether the gold will be or any other instruments will be on your side, or it will be on the other side opposite. Wait for the market news. So always keep an eye on the market news, which is a very important thing, because this is a global market. Now, global market doesn't runs by the, like, if I talk about the global market runs by Asia, or South America, or North America. It's not like that. It's a global market, has a vast, like, Middle East. Every news has an impact on each and every instruments. Every news, every news. It means, how, if I talk about currency pairs, daily you go to the Walmart, or you go to any currency transactions, like, for an example, you want to send money, you want to receive money from West Zone, right, or Western Union, or some Walmart. You go there, you depositing the money. But whenever you're depositing or sending money, you can see there is always a buying and selling price. There's a difference is always there, right? So it always impact on the market as well. You can always see there's a buying price, there's a selling price. There always a slight difference will be there. So those are the instruments, those are the global impact, how the currency pair works. Now, one more thing you might be wondering, like, why this market has a two price. There is always a bid price, and there is always an ask price. Okay. So what we call in trading industry, it's called buying price and a selling price. Now let's take an example. If you're a trader, you might have noticed, like, there's always a difference on buying and selling. there's always a difference on buying and selling. Now, whenever you see the difference between a buying and selling, like 0.01, 0.02 cents, 0.01 cents, 0.05 cents, those are called spreads. Okay. Spreads means the difference between buying and selling. With the help of the spreads, the graphs keeps on moving. With the help of the spreads, like, your trades keeps on running also. Now you might be wondering, like, whenever I open a trade, like, for an example, you're opening some trades, and you see the trades open automatically into the negative. It happens like whenever you're, because this is a CFD trading. CFD means contract for difference. Now, whenever you're opening any trades, your trades open with the negative. The reason is that because of the spreads. Now, let's take an example. You're buying something on the market. The buying price is $10 and the selling price is $9. You're buying something in the market with the $10, it automatically picks up your selling price. So whenever there is a difference between buying and selling, there will be a small difference, 0.1 cents, 0.2 cents. Those difference will automatically start. That's the reason in CFD trading, whenever you're trading on CFD, your trade starts with the negative. And the basic things which is the trader always forget about is the leverage. Leverage can always help you, as I explained you earlier also. Leverage can always help you, but it can hamper you also. So try to minimize your risk as much as possible. Taking a huge leverage. Leverage is in terms like, if I give an example, leverage in terms is like it's a credit given to you as a from the company. So more you take the credit, it will take time for you to give it back. So try to take a less leverage, try to have a risk appetite, try to know when to start and when to stop. Don't be into rush into the market, because this market is 24 by 7 apart from Saturday and Sunday. However, cryptocurrencies are 24 by 7. But still, there is always have a positive news on the market. There is always have a negative news on the market. But run the market according to the news, because this market is not running by me or not running by you people. It's always run by the news. Now, today, for an example, Joe Biden or some other government company agencies started talking about, like, this is the dollar is going down or this is the dollar is going up, how we're going to build up our economy, what will be our plan for down the line for next quarterly report, like, for 3 months, how much funds we need to invest on building managements, or how much funds we have to secure the jobless claims, like, secure the jobless people. So those always impact on the market. Now, how you will get the access is an economic calendar, which our company send you always, like, on a daily basis. Now, with the help of this, you can always, as I suggested you, whenever you start any trade, analyze the market, should be a good on the risk appetite, should know when to start the trade, when to stop the trade, and you should be positive. Like, you should be positive. Yes, market will be with you and will be against you also sometimes, but don't lose hope. Like, if I talk about my clients, they're trading, like, more than 10 years, 10 years, 12 years, they're in this market. Yes, because initial days, you understand, like, yes, there are some risks because I'm not aware about the market. We always think if I have the small amount, I'll make the big money out of that. That is not possible until unless you don't know what is the market is all about. So you should have a risk appetite on that. If I talk about, this is the basic things you should be always be aware. And also, this leverage, with the help of leverage, you can pick up a good instruments with a small amount. Always should be as I said, like, risk appetite is good instruments, but you should be aware about, like, instruments, where to start, which instruments you will be focusing on, which instruments will have a more impact on the market. There are some indices, like, if I talk about US Tech 100, if I talk about Nasdaq, Dow Jones, S&P 500, German 30, France 40. Those are the instruments, like, they runs according to their timing. Like, for an example, if I talk about German 30 or UK 100, they runs on the European time. So when the German market opens, when the France market or the UK market opens, you can see the huge volatility on those instruments. Now, if I talk about Nasdaq, If I talk about German, if I talk about Dow Jones, S&P 500, when the US market opens, you can see the huge volatility on the market with those instruments. Try to keep yourself bit patience with when the volatility comes into the markets. Whenever you can see there is a opening time or the closing time, you can see the huge volatility in the market. It seems like you have opened a store. Let's take an example. You have opened a one computer shop. Now there are lots of demand for your computers in this market. So you can see there are multiple people waiting in queue to buy the computers from your shop. But on top of that, by end of the day you put a discount. Let's take an example. At end of the day you put a 50% discount on your computers. So you can see while opening you have a huge people who wants to buy your computers. While closing, when you're going to close your shop and it's a day end for you, you put a label of 50% discount. There are customers who wants to come and buy your laptops. So it's same as a market also, but without discounts. Don't take me the other side around. It's same as a market. So whenever the market opens, market has a time zone, European time zone. We have like a US time zone. We have like South Asia Pacific time zones. So whenever the market opening timings are there, there are instruments who has a huge volatility. So try to keep yourself away from those volatilities so that you should not burn your fingers in a small time frame. Try to be a long runner. Like if you think today I buy something positive in the market and the price started falling down, and I'll keep on buying until unless it won't come to my price range. It doesn't help it, because what would happen? You have $100,000, you buy a 20 lots of some instruments, the trade's going negative. Then again you are buying 20 lots, expecting I'm buying, and the trade will automatically comes into profit. What would happen if the market started going against you? You're going to lose the money, right? This is where I always suggest my client choose the volume size very wisely according to your capital. Choose the stop loss. Always utilize the stop loss. Always utilize the take profit. Don't jump to the market without knowing, instantly. For an example, I want to buy something from the $10, but I can see the market from past 3 hours, 4 hours, it's constantly repeating the same graph. It's dropping to $7, then again it's going $10, then again it's dropping to $8. On those scenarios, what the best you can do? You can always use buy limit. You can always use sell limit. So rather going for the market execution instantly, you can always use a buy limit and sell limit option. The buy limit options or a sell limit, I'd like to explain you on this. Buy limit, it means like you're buying something. For an example, you want to buy a product of $10, but you can see the product is always going up and down. Like for an example, it goes to $15, then again it's coming back to the $10. So you put a cap, I for buy limit, I choose the volume size. I put a buy limit of this instruments on the $8. Okay. Now on $8, once the market automatically reveals itself, the market automatically going down. Once it is touch $8, then only your trade will start from there. Okay. So this is the utilization. It means you're not jumping to the market with the market execution instantly. You put a buy limit on that. Now, same goes with the sell limit. I want to sell something from, let's take an example from $500 or $1,000. I want to sell something, but I can see like the graphs are still moving. Market is not consistent. The market is taking time to come to this range, and then again it's going up. But you set your goal. Okay, I want to sell the instrument from the $1,000. The market is running currently on the $1,500 or $2,000, but I'll wait for let the market. I want to sell it from the $1,000. Once the market started comes to $1,000, then only the price will start falling down. Then your trade will get open automatically. So these are the things you can always look forward for: buy limit, sell limit, volume size. Again and again, I like to tell my people or my clients, my all my fellow colleagues, like always choose the volume size wisely, because volume size is something which can give you the good profit in the market, but it can always hamper. So with this buy limit, sell limit, you can always put a stop loss, take profit with a volume size also. So in short, you should know your risk appetite. You should know your risk management. You should be always be aware about like what is my balance, What do I understand by balance or equity, margin, margin level percentage, free margin? What are those things? So with this, like, I'll definitely clear those things like balance. If I talk about balance, whenever you deposit an initial amount, let's take an example. You started with a $10,000 today. So the amount, $10,000 is the balance, the main account, the main amount which you have deposited for the trading. Equity. Equity means the current status of your account. Equity means the current status of your account. If I talk about margin, margin means the amount which is currently blocked for the trade. Let's take an example from $10,000. You purchase something for $100, right? Now, if you purchase something for $100, the amount which is blocked, the $100 is called margin. So remaining equity will be your $9,900 in your account. So margin means the amount which is currently blocked for the current trade. It's called margin. Pre-margin means this much balance is available, this much amount is available for your further trade. Now, if I talk about margin level percentage is nothing. It's just an indicator for you so that you should always be aware. Like, after this, your trade will be get closed automatically. Now, let's take an example. You have a $5,000, $10,000 in your account. There are 4 or 5 trades are running, and your margin level percentage is going below 100%, below 50%. It means you are getting an indicator that either you deposit the money, save the trade, or either you just simply pray so that you can come out of the trade with a profit. So margin level percentages always give you the indications. Like with TNFX, if I talk about, we give you the margin level percentage of 20%. It means still the 20% we are giving you a chance, you can save your trade. But after 20%, automatically you can see you have a 4 trades open. All fours are running on the negative. The first trade, which is running on the negative with a huge amount of loss, it will get closed automatically. So till 20%, you have a chance that you can deposit something, you can save your trade, or you can simply pray to the god so that you can come out of the trade with a profit. And with this, I will also explain you this balance, equity, margin, free margin, margin level percentage, that you should have a clear idea, like, how my trades are going to open, what is my basic principle, what is my calculations on the trade. Until unless you don't know the calculation on the trade, don't jump it. Like, if I should if I'll tell you, like, for an example, I want to buy something with 0.01 volume size. So I should know the calculation. What will be the calculation of 0.01? If I want to open something for 100, like if I want to buy something in a one lot or 100 shares I want to buy, what will be the calculation with that? What is my amount is there in the account? So there is a 0.01 will block the small amount, and 100 shares, like one lot, will block the different amount. But before you open any trade, the leverage, like, as I said, like, leverage will give you the credit. And if you're thinking, like, with my $1,000 I can buy 100,000 shares, it's not at all like that. But it's just a leverage. But the amount leverage, with the leverage, you are risking up also. So it means, like, 0.01, as I said, like, 0.01 give you the specific amount which will gonna block, and 100 shares, like one lot, it will block a different amount. But you should know the calculation before opening any trade. uh, those topics I'll definitely coming to the further in days, like, further for the few days. I'll request my team to arrange one more webinar for every one of us, so that I can explain you uh, how to do the calculations, because doing the calculation is very much important in this market. Whether you have $100 with you, or either you have $100,000 with you, you should know the calculations. You should know, like, with $100, how much amount I'll be able to open this trade, and how much amount this amount will gonna block it, and how much profit I can make it. You should be aware about the calculations. So those calculations, I'll make sure, like, on the next topic, on whenever I'll get a next chance to talk to you people, I'll definitely cover it up for you. Now, after this, if you guys have any questions, you can definitely drop us an email to our backend teams, and you can definitely uh, send us an email to our team. We have dedicated relationship managers who will love to give you all the answers of your queries. So as I said, like, good luck with your trading. So always should aware like when to start, when to stop. Risk appetite, as I explained you, those are the basic topics I want to cover it up today. Like risk appetite, you should be always aware about the risk appetite, when to enter to the market, when to exit from the market. You should be always aware about that. But yes, I'll definitely come back to you guys with the calculations so that on next time whenever we're gonna interact, I'll teach you completely what is the how the calculation is going to work, or I'll give you some examples on how, by opening some small volume, by opening a big volume, and you can always see like how the balance, how the equity or free margin level percentage, what are those. I'll give you the live uh, updates, or I'll show you the live indicators on that. Yeah. So till the time, if you have any questions, you can definitely get in touch with us. You can drop us your any queries by an email, or you can always call 24/7. We have a dedicated customer support team as well. You can get in touch with us. Thank you so much, and have a wonderful evening. Thank you.